It's functionally a marching band marching across a bridge, right? And the bridge develops resonance, right? As they stomp in unison, the bridge develops resonance and it begins to move more and more and more wildly, right? That is what is going to happen to our market.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. Next week on the Phil Bach Podcast, we have the man, the myth, the legend, Eric Balchunas, talking markets, ETFs, Jack Bogle, and more. As part of the prep for that podcast, Eric put out an open call on Twitter to poll sentiment ahead of one of the topics that we were set to debate, which is the state of price discovery in the markets. Mike Green from Logica Capital, one of the most provocative voices in this debate, responded to the tweet, and I invited him to jump in and debate with us. What follows here is the full debate with Mike Green and Eric Balchunas. I got to say, it was a little bit unfair to Eric because he got ambushed with a 2-on-1, but still it was a fun debate. It was a thoughtful debate, and I think it's a very important debate, and one that I hope gets more attention and ultimately, brings some ideas about how to fix what I consider to be a real risk in market structure. So please enjoy this debate, and I'll be posting the full interview with Eric Balchunas in a few days. So one of the things that's been discussed for quite a while is the idea that narratives have replaced fundamentals in the marketplace. And you look at passive flows and just the dominance of passive flows relative to active flows. And there was a lot of debate about whether ETFs, and when people say ETFs, really what they mean is market cap weighted index investing in any vehicle, but whether passive investing, and we'll just use passive or ETFs in lieu of market cap weighted specifically, but whether that replacing the active manager has taken away the function of price discovery in the market. Now, there's a lot of pieces to this argument, and a lot of my thoughts on it have been formed by a guy named Mike Green, who is really one of the leading voices in this. So one of the ideas is passive flows replacing active, of course, but also we see now more volume in the options market than we see in the equity market, and market makers are all just basically Delta One arb desks, right? They're all just providing fleeting liquidity based on where derivatives are trading. You look at what happened to the FANGs and how the narrative of the FANGs just turned into this runaway valuation, and then it became comical with Tesla, and now it's becoming way more than comical with GameStop, right? And you add to that all the, taking the Fed taking risk off the table, and now everyone's just disrespecting risk, and you see that in, high yield spreads, you see it in the way people are allocating, you see it now in the frenzy that, really hadn't been there until recent months, but the frenzy of high risk investing and individual investors. And all this leads me to believe that, in fact, price discovery has been removed from the marketplace, that there's nothing tethering the value of an asset to the intrinsic value of the asset. And I know, Eric, you've been very skeptical on this point, but really the person who can best articulate this point, like I said, is Mike Green. Mike just called into the podcast and is going to join us as well to help back me up on this assertion.
How you doing, Phil?
Hey, Mike, thanks for coming on. So, Eric, let's throw it to you. I mean, I know it's it's a wild thesis, and it should really be on me and Mike to kind of prove it. But you're the skeptic of everything I just said. So let me kind of let you start with why you think that this is hysterical or not accurate.
Well, I think part of what you're saying is true, at least in my opinion. But I just look at some of these numbers, like trading volume hit a record last year. I think this is right. There's about $140 trillion worth of trading. That's way more. So there's a ton of trading. It's not like passive has soaked up all of the active players. There's still, 80% of the ownership of the stocks are non-passive. Now, that said, some of these active fund companies that are supposed to be active are passive-ish, like Fidelity funds. And they're very, I won't say closet indexing, but they definitely have a lot of the index in there. So maybe if you take passive plus the closet indexing, perhaps you are left with the ability for some crazy day traders to sort of hijack the price for a while. But then it's like, why is that happening? Is that commission-free trading? Is that the Fed? So I think all this is really fascinating. I'm so used to passive getting the target for this. And I just think passive, I think this might clear passive's name finally. Because I think I've always said, when you look at the ownership of the stock market, 40% are, quote, households. And I used to joke that, like, hey, how come nobody's focused on these households? What about them? Are they the ticking time bomb? And perhaps maybe it's time to look at that chunk of the ownership. But certainly GameStop at that price, even Tesla, it does look like price discovery is whacked, but there's as much trading as ever. So it's hard to say that there's not like anybody trading and the stock's just sitting there.
Mike, what do you think?
So the pushback that I'd make on that is this: when you talk about trading, right? There's two different types of trading. There's an individual or a fund manager that chooses to buy a stock on the basis of fundamentals, and then there's an incredible amount of trading that's being created by authorized participants and the ETF creation redemption process, right? Where effectively I'm buying a basket of stocks to present to the ETF sponsor with the objective of obtaining the ETF itself, right? In that creation redemption basket. The second component is when you talk about passive and you refer to it being about 20%, what you're capturing there are primarily the mutual funds and the index ETFs, but what you're missing in that framework is a significant institutional components, whether that's total return swaps, futures, the institutional replication of index type products in vehicles other than total return swaps, things like CITs, commingled investment trusts, which are white label mutual fund type products. When you incorporate all of those, you get north of 40%. And when you look at the quantity of trading that either involves some form of index arbitrage, creation, redemption, as I was referring to, it looks, Eric, like it's more like 90% of all trading activity is now tied in one form or another to this index process.
I have to check that. That seems high to me, but that's a good point. And the SMAs, the non-fund passive, certainly we can't see that. And CITs, there's a lot. I think there's 4 trillion in CITs. I think 3 trillion of that might be passive. I'm ballparking these numbers. But yeah, I also think some of that passive isn't passive. These are smart beta products. I think 25% of that is funds that weight a little differently than market cap. So you could argue they're systematic active, if you will, or rules-based active. But if passive really controlled everything, I just don't know how I guess my question, how is Tesla going up so much? I mean, there's not nearly as many flows into Tesla that would dictate that price movement.
So what's interesting is a paper that just came out in December of 2020 by a professor at University of Michigan, Zhang is his name. And he, I think, correctly identifies the underlying mechanism. Nobody thinks that it's all passive, right? I mean, I hopefully have emphasized this enough times. I don't think that passive is, as Robin Wigglesworth tried to tar me with, a theory of everything, right? It is a contributing and an increasingly powerful influence on the market that functionally turns something like Tesla into a Veblen good, meaning the demand for it goes up as the price rises. That's a function of how you construct a market cap or a market value weighted index. As the price rises, instead of it representing a lower return in the future, instead it is viewed by an index provider or an index fund as representing the collective wisdom of the assembled investors, and therefore it becomes more valuable. The last price is the correct price. Part of what I would suggest is happening is as that becomes larger and larger, and as the passive vehicles have a larger influence in terms of the incremental dollar that comes in, what you're seeing is the impact of those larger purchases, right? So when Vanguard takes in $1,000, it needs to spend $50 buying Apple. That's more than any other fund would have to spend on that $1,000. And if that money came into an active manager, that active manager would actually first hold cash and consider where he wanted to allocate that. None of that happens with the passive vehicles. And so it simply increases what I describe as the inelasticity of the market. It effectively exaggerates the movements that we're seeing. I would suggest that's exactly what we saw with GameStop. While the marginal flows are small, there is nothing that you could do to induce Vanguard to sell GameStop based on price appreciation. Whereas Michael Burry, who kudos to him for identifying the security on an individual basis, he's been actively selling into this whole process, providing liquidity. Vanguard has been doing the opposite.
There's so much liquidity in the market right now. Market makers, we've never had, things trading as fast, as deep, as liquid, but the liquidity is so incredibly fleeting where it's all just Delta One arb, right? It's all people are arbitraging what they can sell or buy it off of in one market against a derivative in the other market, but that's not true liquidity. Liquidity based on price levels. So somebody saying that I'm willing to buy, I am a a big brokerage firm or an institutional asset manager that's willing to buy a stock at 50 but not at 60. Or I'm willing to sell it at 70, but that just doesn't exist. There's nobody making markets based off price levels. So there's no resistance when things start trading out of whack. There's no mechanism to pull it back into place. There's no, human broker to say, what are you, crazy? You want to buy this? There's just, it's just these things just go when they go. And we're seeing that play out in real time with GameStop. So it doesn't mean that there's no price discovery, that the three of us can't settle on a new valuation for a stock and trade it up or down to that level. We certainly can, but that's kind of the problem. If people are trading without any idea of what something is worth, where the valuation based on any normal fundamental or intrinsic value doesn't matter at all, and we're seeing that in a number of stocks in the market, even before this whole Reddit explosion, there's no resistance or anything to soften the way up. It just goes, right? And when we saw that with Tesla, I think more than anything else, where Tesla's doing 1.5% of global auto sales, and their market cap is higher than the entire auto sector ex-Tesla combined, which is crazy. I mean, I don't care how good their batteries or their technology is. That is just insane. And, again, I think the lack of somebody saying, well, a market maker who's making a market based on the value of Tesla, like we had maybe 30 or 40 years ago, is very different than a market maker who's making the market based on, what their overall book exposure and what options they've sold.
Well, now, let me ask you this, though. That just seems like cyclical. If you go back to the late 90s, passive was a very small minority of the market, and you had that kind of radical disconnection from fundamentals of many stocks. So, how do you explain past crashes then?
Well, first of all, again, passive is not everything, right? I just want to emphasize that. But actually what happened in the late 90s, we saw this replicated in the Shanghai stock market in 2015. What happened in the late 90s was that the index was improperly constructed. So if we go prior to 2004, the indices were market cap weighted, not float weighted. And what that meant was that when money tried to flow into the indices, they were trying to buy stocks in proportion to their market caps. Low float companies like Microsoft, Cisco, Dell, where the founders continued to own a significant fraction, or companies that had relatively recently IPO'd and were included in these indices, received outsized buying pressure against their stocks. In other words, Microsoft was receiving a bid for twice as many shares as actually existed. That caused it to outperform. That low float factor was the single biggest describer of returns, the single biggest factor in terms of returns from 95 to 98, at which point it began to reflect an overlap with another sector. Low float stocks tend to be those that have relatively recently IPO'd, which is just another way of saying technology stocks in the late 90s. That's what really drove the dot-com cycle. If you adjust for that factor, you'll discover that you really didn't have the same sort of performance. You can look at the median stock in the S&P 500, for example. You'll see none of the bubble-like characteristics.
So, well, you're saying that even though passive funds were, 4% of the market share back in the mid-90s, that the index and SMAs were enough to push the prices. So it was still a passive problem in the 90s.
I think that what we saw with the dot-com cycle was passive 1.0 influenced the market significantly. As a participant, I will tell you that the single biggest risk that we faced was replacement by index funds, not by replacement by other managers. The second thing that I would highlight on that, though, is that morphed, right? Because we didn't have factor funds back in the mid-1990s. We had technology funds or industrial funds. The outperformance that was caused by the overlap with the float factor caused the flow of funds into technology, caused people to chase returns. And so the last stages of that, from 99 to 2000, I would argue, is more what you think of in the dot-com cycle. But the contributing factor that led to it was a 1994 decision by the SEC to allow the use of derivatives to replicate index funds. That's what began the irrational exuberance that began to manifest in 95, 96.
Yeah, look, I was there and I was just out of college, and my roommate, like people I knew, were just buying Microsoft. They were not buying it through an SMA. It was the same thing, the way people are buying Tesla now through their brokerage account. And I felt like all the big popular funds were active and they were doing great because they kept buying Microsoft. It's interesting. I guess the index has always been a big factor, but without the flows into passive, just seems like a harder case to make in the 90s than today. Today, clearly a lot of the flows are going to passive, and there's no doubt. Although I would say one thing, though, is like If we go to last year, there was, I think, 120 billion into equity index ETFs. Equity index mutual funds saw a little bit of outflows. That isn't, I mean, that's a low haul for them. And the S&P 500 ETF saw outflows. It strikes me as there's got to be some other forces involved to get the market to do what it did beyond that level of flows relative to the size of the stock market. I mean, it wasn't that big of a year, and net mutual funds saw net outflows on the equity side. So there was a drain from the mutual fund side. So, and the market still went up a lot.
What would you attribute that to then?
Individual investors. The one thing I will say is I feel like the index, I have a theory that we call it the Beta Vortex. Basically, if you're a lot of flows go into index funds, and if you're a big money manager with billions, like, I don't know, $40 billion, you're so afraid to do anything that's going to deviate from the index. So you just sort of copy it to a degree because you want to retain assets. You cannot go full Cathie Wood and try to find value in or growth stocks to that extent. So a lot of these funds look like the market. And then what happens is if you don't look like the market, you see outflows. So like even smart beta funds, like if there's all these value and growth funds, the one that looks closest to the market tend to get, the watered down ones get a lot of the flows. So there's like this upward spiral of things that look like the S&P, even if they're active or smart beta, taking the money. And so I do think there's some kind of a vortex that passive could create, but I think it sucks in a lot of other things too. And arguably it's a demand issue. I don't think investors are doing a good job picking things that are outside of beta or something that looks like beta. They're kind of just performance chasing when they should be maybe picking deep value as a diversifier or picking a market neutral fund. Those don't get any flows. And so I think a lot of these funds have sort of cheated towards beta. And that's one theory. And then obviously the commission-free trading and all of these, we looked at the charts and there's definitely a growth of the retail component of trading. And that's obviously part of it. And the other thing about that is more so this past couple months, especially we've seen stocks trade more than SPY. And that just tells me there is such a hunger for the more volatile stocks as opposed to the sort of watered down index. So some of these retail traders are actually bored by passive. They want something with more juice, hence the GameStop and Tesla volume being more than SPY. Nothing's traded more than SPY in like 20 years. So I guess in short, that's where I think there's some, we sometimes say passive sort of in the back seat and active players are driving the car, which is how a stock can go into the S&P, but then it can also get kicked out because active is selling, buying it and then selling it based on fundamentals, hopefully. Like Macy's got kicked out, Tesla got added, right? Active kind of determined that. But now the driver of the car seems a little bent, whacked, given all these retail traders. And so I kind of also wonder where are the Fidelities and the T. Rowe in setting these prices because they still have trillions in active assets and they're supposed to be very educated. So I don't know. I think there's just a complicated supply demand issue with anything that you just can't be different than the benchmark right now. And I think you lose flows if you are. So if anything, that's why we tend to refer to it as a vortex, but maybe the core of that is passive and that's the problem. But anyway, those are just some thoughts. Not totally coherent. It's Saturday night.
No. I think that makes sense. But I think a lot of that index hugging phenomena is really just, sector constraints and cap constraints and, all these, everyone wants to show apples to apples alpha. I don't want to be making sector bets, right? I don't want to be making a small cap bet. So I'm going to put in all these constraints to show you how good a stock picker I am. And then, doing so by, being 40 basis points over or underexposed relative to the benchmark on a given name. That looks like, we'll call that, what do you call it again? Index hugging or, it is.
Closet indexing?
Closet indexing. I mean, you could say that's closet indexing, but really it's just the constraints that people have to live with, given that they cannot afford to take the big swings that someone like Cathie Wood can.
So time out. Would you call that career risk?
Oh, yeah, definitely. And franchise risk. Yep.
So career risk, I think, is an underrated factor in all this. There's a lot of hundreds of trillions that are career risk oriented, whether it's the advisor who refuses to buy anything that does anything different, or the active mutual fund who is afraid to make bets based on fundamentals they believe in. Is that a fair statement?
But then we're looking back at the people who've taken the most amount of risk. We're looking back at at Cathie Wood and the retail investors and saying that was the better thing to do, the more prudent thing to do. They've got the best returns. But that's in an environment where risk has been taken off the table by the Fed, entirely off the table. So yeah, of course you just swing for the upside when there's no risk. But is that going to be the case going forward? I don't know. I don't think so.
Fed is Mike, what do you think of the Fed, by the way? Like, do you think that's a big variable here or no?
So I think the Fed influences markets slightly differently than most people think. The primary role that it plays, and actually there's another academic paper that came out in 2020. 2020, by the way, was a very fruitful year for academic papers beginning to ask the right question. So until 2020, all the papers had asked, how is an individual stock affected by inclusion in an index? In 2020, people started to wake up and say, how is the market affected by the growth of passive? So Jonathan Parker at MIT wrote an interesting paper looking at financial innovation and the impact of target date funds. And he identified the same phenomenon that I basically do, which says when the Fed cuts interest rates, it raises the price of bonds. A balanced fund that has to maintain an allocation between equities and bonds then suddenly has pressure to buy equities, right? It has ammo to buy equities. It's not hitting the market as in the indirect fashion that the lower interest rate is driving an increase in consumption or an increase in investment. What's actually happening is a rebalancing factor within the portfolio. We know explicitly that Vanguard and other target date funds do this, and those are very large players at this point in time. So all the indications that I have is that the Fed's influence is largely in the creation of collateral at this point as compared to the idea that they are meaningfully influencing. Obviously, when they step in and say, hey, we'll buy high yield bonds and create a floor under those, that's further reducing the need to hedge, et cetera. But if we actually look at the quantity of high yield bonds they bought, for example, it's just jawboning at this point, right? They really didn't buy very much at all. I think it was like, I want to say something ridiculous, like $80 million. The second point, though, that I think that you hit on is this idea of career risk, right? And I certainly think that's true, but I would suggest that part of what has happened is that we have, the vast majority of portfolio managers are either constrained from a regulatory standpoint. If you're a mutual fund and you want to maintain the characteristic of being a diversified fund, which allows you to market more broadly than if you were a non-diversified fund, you're limited in terms of how much market cap or how much of your fund you can allocate to individual names. One of the things that's been so interesting is that the SEC has continually stepped in to facilitate the growth of passive. In the third quarter of 2019, when Microsoft, Facebook, Alphabet, formerly Google, Netflix, and I'm forgetting the last one, grew large enough, if you looked at something like the S&P 500 growth, that was no longer a diversified fund. Right? It shouldn't have been eligible for marketing to the vast majority of individuals. And the SEC actually stepped in and said, oh, don't worry about it. Right? We're going to give you what's called a no action letter so that you don't have to worry about this dynamic. Right? We continually see this regulatory reinforcement. I mean, among other things that has occurred is the implementation of phase one of the DOL fiduciary rule created conditions under which there's now a giant cottage industry suing corporations that are offering 401ks if they offer anything other than the cheapest index funds, right? Fidelity actually had to settle a class action lawsuit brought by its employees because they offered Fidelity funds in their 401k. This is now extending globally. If you look at Australia, Australia has actually instituted a regulation starting September of 2020 in which if you are participating in their superannuation, which is the equivalent of the American 401k system, and you fail to perform in line with your benchmark for 2 years, you're no longer eligible for inclusion. So what is happening? Everybody is being forced to hug the benchmark. Everyone is forced to become a closet passive investor. Sure. And all of this is being created by the lobbying activities of the passive players.
I just have to, I can't skip over that. You're saying that the employees of Fidelity sued Fidelity for using Fidelity funds, which are the product of the employees of Fidelity, in the Fidelity 401k. Did that happen?
They sued and Fidelity had to settle.
So I think I know what you're talking about. There's some record keeping and administrative fees that arguably are egregious, though. And they're hidden fees that they don't tell. Fidelity is an interesting one, but that aside, I guess let me ask you this. Do you think the active fund industry has any hand in creating this scenario by potentially really milking the gravy of dollar fees in a market that's gone up 300% and never passing on any of the economies of scale? And then Vanguard comes along and says, we actually did all that and they're 8 times cheaper. I mean, can you really blame the consumer?
I don't think it's the consumer. I would again suggest that the vast majority of choice has been removed from the system. So if you look at most 401ks, they no longer offer anything other than a target date fund. They no longer offer anything other than passive vehicles. In particular, this is because of the DOL fiduciary rule that was phase 1 implementation was January of 2017. We also have the dynamic of qualified default investment alternatives, which were introduced in 2006. That automatically put people into this. And again, the Biden administration is now considering regulatory changes that for you as an employee to get out of a target date fund, you will have to pass a financial literacy test, right? So you have conditions in place that are completely absurd. They prevent the growth or any realistic opportunity for active managers to capture any funds that are going into retirement accounts. In terms of whether the fees have been milked, I would suggest that what has actually happened is that the price appreciation has anesthetized the active manager community to its functional immolation, right? It is being boiled alive, and it's okay because it's capturing fees. But it's absurd to argue that fees have not fallen over time, right? They've fallen dramatically over the past 20 years, both within the active manager community and within the passive manager community.
Yes, a little, but only when forced, and as the dollar amount, the dollar fees have grown. I mean, we studied this
alongside the assets. Yes,
we're amazed that a fund like the Contra Fund can see like $26 billion in outflows and end the year with more assets and make more money. There's no other business that happens in, and I think, look, it doesn't even. I mean, I honestly, when I talk to people that I know, and people just aren't going to pay a lot for funds. I don't know whether the industry put that in their head or they had a bad experience in a mutual fund or their broker screwed them by getting a kickback in one of these funds that sucked, put them in there, and they switched to go to an RIA who's more fiduciary. But I don't know. There just seems to be a lot of responsibility here from the active side. That's just my take. That opened the door for all this passive and Vanguard, in my opinion.
So again, I think that it's important to consider the regulatory framework, right? So the regulations that were introduced in 2006 had a huge impact in terms of the accelerated growth. The introduction in 1994 of the derivative project or the derivative study, I forget what it's actually called, by the Harvey Pitt SEC that facilitated violations of the 40 Act that allow funds like Vanguard to use margin accounts and buy futures, which they were not allowed to do prior to 1994, right? Those substantive structural changes have facilitated the growth of the industry in an explosive fashion. It is not simply a function of higher fees. It is the second thing that I would highlight, though, Eric, and you've seen my analysis on this, and I would point you to another academic paper that came out in 2020. This is Gabay and Koijin with what they refer to as the inelastic market hypothesis. And what is happening is as you increasingly move to price inelastic buyers, you are seeing markets rise more rapidly on each incremental dollar that comes in, right? That's what's driving the expansion. That's what's driving the increase in valuations. And yes, active managers are benefiting from that. And should they theoretically be cutting their costs and sharing more with investors? Sure, you can make that argument, but that's not what's driving the behavior we're seeing.
Right. And I think, Eric, you're going back to the old, active versus passive or mutual fund versus ETF framework, but it's much bigger than that. I mean, look at even in the RIA market where you used to have all these regional RIAs that would pick their favorite funds based on, whatever, Morningstar or wholesalers or whatever it is, but they would have all these little active funds. Now they're all being gobbled up. They're all being consolidated and they're all using the same passive ETFs with like a 200-day moving average tactical overlay. I mean, how many times have we seen that, right? They're all on these TAM platforms, which are dominated by underlying, passive ETFs used as a tool to do some sort of macro rotational strategy. And then you look at the proliferation of derivatives. Derivatives are 100% indexed. Every future, every option is 100% indexed. So it's not just the mutual funds versus ETFs. It's much, much bigger than that.
it seems like if you're even active managers, I can't prove this, but when it comes to their personal account, their kids' retirement, I have to wonder, are they buying their own funds? Are they, if you're an RIA and you're fiduciary, do you feel comfortable picking an active fund where it has a third of a chance to outperform in 1 year and 10% chance over 15, 20 years? I mean, that's just low odds. I mean, can you not empathize with when nobody is looking and it's your own money, why you would pick passive, regardless, even if you believed everything about this market structure problem, you're still picking that based on self-interest. I get that. I mean, I empathize with that choice, and I see people do it all around me. And I think even people in the industry who run money do this with their retirement accounts.
So I would suggest that part of that is a function of convenience. If I want to self-direct my 401k, or if I want to self-direct my kid's 529, I have to go through a process that I otherwise wouldn't have to. Again, I think that speaks to the underlying character of the importance of these regulatory changes in driving behavior. The second thing that I would highlight is I agree with you. Until I started coming out and saying, hey, wait a second, the problem is not that active managers are terrible. The problem is that passive managers are starting to change the structure of the market quite significantly. I would agree with you. The vast majority of active managers are sitting there in self-doubt saying, man, I don't understand how I'm so bad at this.
And so let's go to regulatory. Let's say that you got, instead of Gary Gensler, they chose you. Or I'll just say king for a day instead of, because I know there's different, you can't just make all the rules as chair. But let's say you're king for the day. What one or two changes would you make to the market instantly to sort of maybe make it so that it wasn't so dependent on this inelastic price demand? Or I forget what you called it, but inelasticity.
Inelastic market hypothesis.
Right.
That's Gabay and Koigen, although I tend to agree with it. I would actually suggest that Gabay and Koigen's work doesn't go far enough and that they don't disaggregate the impact of active versus passive. They just isolate this impact of inelasticity, which is a violation of the efficient market hypothesis. And that violation of the efficient market hypothesis ultimately says passive can't work, right? I mean, there's a fundamental flaw in the idea of passive. It goes back to Bill Sharp's paper in 1991, The Arithmetic of Active Management, in which he describes passive vehicles as those which hold all the securities, right? So first of all, we know that there is no complete index that incorporates all the individual securities, right? So we're making an adjustment to that, right? An accommodation to reality. The second thing, though, is that it's not a question of whether they're holding, although I do think that is actually an active choice. The decision to hodl in Bitcoin has a clear impact on the inelasticity of Bitcoin, its capacity to change price given smaller inflows, right? But the most important thing that is missing in Bill Sharp's analysis of the active versus passive difference is that passive is in the market every single day because of investor inflows. Right? They are buying, and therefore, by definition, they are not passive vehicles. They are actually active vehicles that operate off of the world's simplest algorithms. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And as a result, we see highly inelastic markets that are becoming more inelastic and more brittle. So when you see something like GameStop, you can have these extreme behaviors because 40% of the holders, there's no way you can get them to sell. And as a matter of fact, as the price rises, they're going to buy more, not by virtue of them deciding it's a better company on the existing holders, but because every day Vanguard gets inflows. And
I mean, yeah, that's true. I think, I don't know, I see some of these short-term issues, even Tesla, as something that just, as a long-term investor, I just look at it as something that will not, I would say noise, that's an understatement, but something that I don't have to be concerned with right now. So I agree. I don't really care about GameStop if I'm in the total market fund. Again, though, what would you do if you were sort of running the show, like one or two things that would, I guess, fix this problem? Would you ban?
Well, when you describe fix this problem, I just want to emphasize that there are two separate problems, right? So one is the immediacy of the impact of passive investment. And I would just very simply suggest that you should immediately declare that BlackRock, State Street, and Vanguard are systemically important financial institutions, that they will have to be able to demonstrate the capacity to unwind themselves, which means they're going to have to carry more cash, right? That would be the single most important thing that you could do. The second thing that I would suggest is that you need to stop treating the markets as a utility for retirement, right? The market does not deliver a return based on Americans' need to retire. The markets are designed to actually facilitate capital allocation. We are misusing them. So in the simplest form, I would address those two issues, right? As a society, we have to decide we're going to treat retirement and the guarantee of income in retirement differently. We can't turn to the markets and try to force this income through this quantity of financial assets through them.
It's going to take a whole zeitgeist change where people are going to have to be able to stomach a loss, a market correction, without screaming to the regulators, without the regulators running around with their hair on fire trying to figure out who to throw money to, without, I don't think we have the fortitude as a country, as an investment class. I don't think we have the fortitude to affect that change.
In other words, investors are coddled. Like if the market goes down 10%, they'll flip out. The Fed will come in time and time again to try to lift the market up. I thought that's what Phil was saying.
Yeah, I mean, functionally though, it's not a question of whether the investors are actually doing that. I mean, the irony is if you look at Fidelity, for example, or not Fidelity, Vanguard, for example, they will suggest that only 1% more than normal of their customers engaged in any transactions in March, right? I think that's actually a really important insight, because if you look at what happened to Vanguard's vehicles, in particular their ETFs and the discounts that they began trading against NAV, right, it was terrible performance. If that happened on a 1% increase in selling, what happens on a 5% increase in selling?
Wait, you're saying that Fidelity's investors, only 1% of them did anything?
Vanguard, not Fidelity.
Yes. Now, you and I we've had several phone calls about this. I feel like we're back there, which I have a theory that if all the Vanguard sellers sold, you're right, that's the shit hitting the fan. I think, though, that the Vanguard buyers are so well behaved and have been trained, and they're used by advisors who are all about behavior. That's their value add, that in sell-off after sell-off, we see them actually as buyers. What I think would happen, and March showed this, if you just take March, that's a month, there was something like, I would say 350 billion out of active in a month. If you extrapolate that over a year, that's a couple trillion probably. And those are owned by boomers. And those funds, they were probably put in there, and they probably don't have much loyalty. They want to cash out before it gets too bad. I just see the next big problem being the demographic, the boomers pulling out of the active funds. And all those active funds have to sell. If anything, passive buying might actually stabilize the market a little. Now, the next one after that, possibly, when I'm like 60, when I'm 70, maybe that's when this Vanguard problem will be more front and center. But I just argue that the active funds are in the front burner of the situation. And I think March was a little sample set that showed that.
So again, actually, we wrote on this at Logica in March. I would agree with you, actually, that what happened in March was that you had active managers selling, not passive managers selling. And I think, thank God, that is the underlying phenomenon, because otherwise it would have been much worse. The dynamic, though, that you're highlighting, right? I mean, there's two separate issues. One, did Vanguard handle that 1% selling well? And I can show you empirically that they did not. The second question, though, is when you talk about investors being well behaved, you correctly identify the demographics. The active managers are in part being sold because their owners are the boomers. Their owners are old, right? Passive share, when we talk about it being 40% of the market, is not split or not homogenous in terms of its distribution, right? Those under the age of 40 are 90+% passive. Those over the age of 70 are only about 15 to 20% passive. Right. So what's happening is we're seeing active managers get sold simply because their clients are selling. Right. And they have no mechanism for capturing those new clients because of the regulatory changes that have occurred. The problem is you just described something really important. The Vanguard investors are so disciplined. They have become so they work so much in concert. Right. That the right way to think about this is that's exactly the right way to think about it. It's functionally a marching band marching across a bridge, right? And the bridge develops resonance, right? As they stomp in unison, the bridge develops resonance and it begins to move more and more and more wildly. right? That is what is going to happen to our market.
I mean, that was going to be my next question, and it sounds like you answered it. Like, what happens if you take what's happening in the markets to the, absolute conclusion, right? If you say we're now 100% passive, like what happens? Like, how does somebody misses earnings, or how does that company find the right price point to trade at?
Well, that's the point. You can't, right? Because at the end of the day, you need somebody to take the other side of a trade. And so as money increasingly flows into passive vehicles, and it's actually important that it's flowing in such a concentrated way, the quanta of net orders, right? So if you think about, I'm buying Vanguard and you're selling Vanguard, as long as we cross each other out, that trade never hits the market, right? But if we both try to sell at the same time and Vanguard is 50% share in the market, which they're not, I just want to emphasize that they are not currently there, but they are capturing somewhere in the neighborhood of 45% of every retirement dollar at this point. So they're gaining share rapidly. And as Eric points out, they have a feedback loop where the larger they get, the cheaper they're able to offer their services. When you think about that sort of dynamic, though, imagine now that Vanguard customers on net decide to sell, right? If they hit the market can't absorb that liquidity. The quanta, the size of that net trade becomes so large that it just can't be met. And that's ultimately, again, where we're headed. I mean, what we're going to see, and again, we wrote about this back in March of 2020, it's near the very lows where we said we're going to be at all-time highs, right? What is actually happening is that we're seeing this rigidity or inelasticity or brittleness manifest itself to the top side. Of course, that feels great as it's happening, except it's driving this chaos in terms of how people are interpreting, because they feel so separated from the actual economy versus what we're seeing as the indicators of the economy and what is being used for political or regulatory framework, right? Do we need to rush out stimulus? No, the S&P is at all-time highs. Why is the S&P at all-time highs? Well, because everybody's expecting stimulus. Right? That's the argument. It becomes circular, and policymakers are increasingly hamstrung by the separation of fundamentals from the actual price action.
Well, there it is. We'll leave it there. Mike, thank you so much for calling in. Eric, thanks for joining the podcast.
It was an absolute pleasure.
All right, and we'll speak to you soon. Thank you.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.